So in the last video, we looked at the allowance for doubtful accounts using the income statement approach method. And I've kept most of those journal entries up on the screen. We are going to, though, at least the ones that are common here, because in this video, we're going to focus on the balance sheet approach. So let's kind of point a couple of these items out so we get our heads around it at least. We have the accounts receivable we debited and the sales we credited for $57.50 because we had some sales on account. And then the other thing in the first quarter we had is we actually had a payment on accounts receivable. Okay, so what I would have done is I had a beginning balance in accounts receivable of $1,200, debit it $57.50, credit it $5,400. So my balance in my accounts receivable account is $1,500. And under the balance sheet approach, this is the focus I'm going to use then to calculate how much to record for my bad debt expense and my allowance for bad debt expense. So in my accounts receivable account, I have $1,550. The company's rate that it uses against the accounts receivable account is 2%, and that gives us a number of $31. Now, this is a two-step process, because the other step in the process is this number we calculate is not the amount we're going to put in the account. This is the amount we want to true it up to. So, for example, this is the amount I want when I get done with the allowance for bad debt. So I want $31 in there. Well, I have none in there to begin with. So my journal entry to get that there will be $31 to the bad debt expense and $31 to the allowance for bad debt. And that will be my journal entry. Okay? You see how that works? All right, so let's go to year 2 then. We now have we have the $1,550 as our beginning balance. We had $6,500. We had sales of accounts receivable, so we have $6,500. We received some of payments against our accounts receivable. We had the amount we wrote off, which was $10, and I need to post this because I erased it. So I would have put the $10 here against the allowance for bad debt, and that would be, right? That's from right here, and I'm going to put that here. And then I had the accounts receivable and the allowance for bad debt, so I would have put this number here. I will put here, right? And then after that, I will have the $4. So then I can calculate my balance in my accounts receivable account, and that is $1,840. And if I calculate the balance in my allowance for bad debt accounts, at this point, it is $25. Okay, I'm going to put a little T here to show that that's a temporary calculation. It's not the final number. So if I look at how much I have in my allowance account or my accounts receivable, I'm going to $1,840. I'm going to use the rate of 2%. So if I calculate that out, that is $36.8. So this is the amount I will want in. This is the amount I want in my allowance for doubtful accounts. So that's the final number I want in there. Well, how do I get that in there? Well, I'm going to credit the allowance for doubtful accounts 11.8, and I will credit the bad debt expense 11.8. Okay, so I will put that here in my journal entries, 11.8. So you can see the focus in this approach is a little bit different than in the income statement approach. The income statement approach calculates the number and just then dumps it in here. Under the balance sheet approach, we calculate what we want the ending number to be and back into the expense for the period. Okay, so let's do this last one then. Our beginning balance in accounts receivable was $1,840. We had sales of $7,000 on account. We received $6,400 on that account. We actually wrote off $30, so I'm going to write off $30 here, and I need to debit my allowance account for that same $30. I then debited my accounts receivable account, which is right here, and I credited my allowance account for that $2. And then I have that last journal entry here, which records here. So my ending balance in my accounts receivable account is $24.10. Okay. My temporary balance in this account, if I can do my math right, is 8.8. And again, let me show that as a temporary account, or a temporary number. Multiply it by the 2%, or multiply my 2410 by the 2%, and that gives me a balance of 48.2. And so what this tells me is this is the amount I want in the allowance for bad debt account. That's the amount I want as my final balance. And what do I have to do to get there? And the number is 39.4. Oh, let me erase that. It is 39.4 credit, not debit. And then there'll be the debit to the bad debt expense. So 39.4 and 39.4. So you can see, again, the focus is on the ending balances here. Let's quickly go to the income statements here and look at what these numbers would be. So the bad debt expense we had in the first year was 31. And that gave us a balance of 2269. Okay. Our ending balance in here, or our bad debt expense in this year, was 11.8. And I believe that gives us 2,589.80. Let's just round it and say 2,588. Let's make this 12, because I can do that math. Let's just make this 12. Let's round, right? It's $12. And let's round this one too. Let's make this one 39 so I can do the math. And let's just say it's 2,761. Okay. And if we had looked at our allowance for bad debt, I'm going to round these numbers also, the $31. So we would have had a balance in there of $1,519, $37 here. And so we would have had a balance of $1,803. And we had a negative $39 balance here, which was, that's not negative 39. That was a negative, that's a negative 48. And so that would have given us a balance of $2,362 in that account. So one thing you want to have you think about when we come to class and discuss these things is, how does the different accounting methods, whether we use the income statement approach or the balance sheet approach, how do these different methods affect the income statement and the balance sheet differently? And I guess one of the things we need to argue, or be able to make the argument, is which method is better and why. All right, so that ends the videos for the allowance for bad debt accounts.